Takes us to our talk of the tape, whether the bear case is tired and overstated, as one Wall Street firm suggested today. Well, let's ask someone who's been negative on stocks for many months. Eric Johnston of Cantor Fitzgerald is with me here at Post 9. Welcome back.
Thank you, Scott.
Are you tired of making this bear case? Is it overstated at this point? Are you sticking to your conviction here?
Yeah, it's not overstated. And the only reason why I'd be tired is that, stocks have performed poorly for now almost 2 years, right? We're down versus where we were just 2 years ago, end of 21 into 2022. So it's been a poor return environment. I think those returns are going to continue to be poor. Now, there's different dynamics, short-term versus long-term, and the short-term dynamics in the next week or so, I think, are actually, somewhat favorable, and will provide a bid to the market. But I think if you look out beyond the next couple weeks and into the next few months, I don't think it's tired at all. I think that, the background fundamentals are actually continuing to get worse.
But this market sort of confounded you and other bears for a while now, right? This isn't just like, you come in here today and saying, well, okay, so the market can go up for another week or a month or what have you. There are many stretches along the way this year where you've been like, look, I'm more negative today than I was 2 weeks ago. Next appearance, I'm even more negative than I was last appearance. And somehow this market's just hung in there. Why?
Yeah, so it's been very resilient. Multiples have stayed higher than I would have expected. I still think they're going to go materially lower, but for right now they've held in. And they've held in because the economy, right? The economy has not rolled over yet, okay? It is weakening. Okay, there's a lot of data points that are suggesting that. We're seeing that from corporations, right? This earnings season, estimates came down for the fourth quarter. The corporate commentary on the conference calls a little bit, right? Continuing claims are up for about 7 straight weeks. Youth unemployment is rising. ISM new orders is falling, and I think this quarter we had 4.5% GDP growth. But if you look at sales growth for corporations, they were up about 1.5%, significantly underperforming what GDP is saying. And their commentary was also a significant sort of underperformance relative to what GDP is saying.
But at what point do you say that, it's not going to roll over like I thought it would? Yes, it's slowing like everybody thought, but it's just not going to roll over like you're suggesting that it still will.
So I think the interest rate picture is a big deal. So over the last 5 months, the 10-year and 30-year yield are up by about 130 basis points. And that's the kind of thing that does not hit the economy right away. And it's also far more important than the Fed funds rate. So if you think about corporate America, right, their debt that they're going to be refinancing in 24 and 25 is on the longer end of the curve. You think what's going on with commercial real estate, you think what's going on with mortgages, auto loans, right? All of that is pegged towards the long end and is going to need to be rolled. And this backup that we've seen in yields is going to be, I think, very problematic. And there clearly is a lag effect to that, right? It doesn't hit people until they need to roll their debt, until a small business needs to raise equity, needs to finance the company. Until that happens, it doesn't hit you. So that's why it is a very important delayed impact.
Well, you're assuming, of course, that rates remain as high as they've been, or perhaps move even higher than some still predict. There is that chance that they might not, right? That they might not.
I mean, the issue is that the supply of treasuries. And so if we have an economy that is chugging along as it is now, then presumably the Fed funds rate is going to stay in and around here. And long end yields are still 50 to 75 basis points below the Fed funds rate, while the Treasury supply that's coming to the market is continuing to rise. Even today, the budget statement came out. Our interest expense this past month was up double $89 billion.
Yeah.
So that's
double than it was a month ago.
That's right. So the issuance next month is going to be higher than this month, and the issuance the following month is going to be higher than that month. It's going to continue to go up. And if we do see an economic downturn, then tax receipts fall, and then that deficit even explodes even more. So it's a very the risks that are out there remain very high, and this market is not priced for those risks that still exist out there.